Skyrocketing interest rates and falling property prices will land about 500,000 households in mortgage prison, unable to refinance to cheaper loans. That's according to the Reserve Bank of Australia, which is preparing to meet next week. And some economists are predicting a pause in rates. Others say it's too early. Dan Jovevski is a finance expert and founder and CEO of WeMoney. He joins me now live. Dan, good to see you. What exactly is mortgage prison? How would you define it?
Well, great to be with you again, Danica. Well, mortgage prison, put simply, Danica, is the inability for mortgage holders that have a desire to refinance their properties but are unable to do so because they don't have sufficient equity or serviceability to move to another bank to save money. And that's causing people to be shackled in with their current providers as interest rates are starting to increase. Now, Danica, we all know that most banks are trying to attract new customers with these low rates. And unfortunately for existing mortgage holders, the people that are with their current banks are often paying the highest rates with their current banks. And being stuck in mortgage prison means that these borrowers can't refinance to save money on their mortgages in the midst of all this economic chaos and calamity.
And do you think that banks know that many of the customers who actually took advantage of ultra low interest rates, they probably won't switch their home loan to another bank? If the value of their property has dropped so much, it's now worth less than their home loan per se. What incentive is there for these bankers to offer any special treatment realistically?
Well, yeah, borrowers are in a tough spot, Danica, and really what we found is that there's two interesting parts of the Australian segment of borrowers that are most affected. And those who are young, so who have recently bought a property with only a 5% deposit or have a loan-to-value ratio of 95%, they're the ones that are most stuck in mortgage prison and unable to refinance. And for those borrowers, interestingly, Danica, what we have seen is that they're tapping one of the 10th largest banks that is not ANZ or NAB or the Commonwealth Bank. It's the bank of mum and dad. They're asking mum and dad again to support them, not only with the initial housing deposit, but also leverage the equity in their parents' home in order to reduce that loan-to-value ratio so they can switch and save. So that's another little savvy tip for younger mortgage holders who may need the help and support from mum and dad again in order to switch to another bank and save themselves money. Conversely, on the opposite side of the spectrum, Danica, for those older Australians, those 50 plus that are now looking towards retirement, banks are increasingly asking the question, what is your exit strategy? And banks are wanting to know what your superannuation balance is and do you have another property of equity so if you do enter retirement and have your income stop, that you can afford to pay that loan. And so there's some of the two sort of larger segments of borrowers that are stuck in mortgage prison. I think compounding all of this stuff as well, Danica, is that the rate of negative equity in Australia has increased from 0.01% now to 2.5% and also increasing as the months go on. And according to CoreLogic now, all major capital cities combined seeing a reduction in property prices around Australia of around 7.8%. So it's further causing a lot of stress amongst Australian households, but there are things that Australian consumers can do, getting support from mum and dad and also looking at other assets that you can use to support your deleveraging. Danica, interestingly enough, that's on the security side, but when you look at towards serviceability, the other thing that major banks are looking towards is things like debt to income ratios. And the magic number here is 6. So if you're earning, say, $100,000 per year, you should have around $600,000 worth of debt or less in order to meet that initial criteria. And what a lot of people are doing now is actually looking at taking jobs part-time on the weekend to buffer up their income side of their balance sheet. So when they do go to the bank, yes, they've got the equity, but now they've got the serviceability in order to help them refinance their mortgage to a cheaper rate. And finally, Danica, the one thing that we used to do 20 or 30 years ago is dress up in our Sunday's best, go meet the bank manager and explain why we had great character in order to repay a loan. Those days are unfortunately gone, with most banks now using computer algorithms in order to determine whether or not borrowers can be approved for a loan. And what they're looking for in particular is, have you accessed any short-term lending products or made excessive credit inquiries with certain lenders? And that's a sign of stress for the bank if you have access, say, something like a short-term credit loan at a high interest rate. And so you want to make sure you avoid those type of credit applications. And the best way for Australian consumers to uncover what's on their credit file is go and seek that directly from the credit bureaus themselves. So Australian consumers can get their credit score for free from either Equifax, Experian or Illion and receive their credit report exactly in the same format that a bank would receive it, just to make sure there's no blemishes on their credit file before they go through that process of refinancing their mortgage and hopefully getting themselves out of mortgage prison.
Yeah, some really good advice when you think that there'll be tens of thousands of people stuck at the moment in this mortgage prison. Before we let you go, Dan, can I just get your thoughts? Do you think that the RBA will pause rates next week?
Well, with all the calamity that's happening externally around the world, especially in Europe and the US, Janika, I think that the RBA is thinking twice. Jim Chambers obviously said he was pessimistically cautious on whether or not we'd broken the back of inflation. But I think sort of CBA is leading the charge and being the most optimistic with predicting that the RBA cash rate will fall to as low as 2.85% by May next year, with about a 50-point decrease in the last quarter of 2023, hopefully giving some borrowers some reprieve in the lead up to Christmas. My personal view, Janika, is I think they might increase it one more time by 25 basis points before they put it on pause ahead of the May meeting.
Well, everyone will be, those who have a mortgage, will be watching that meeting very closely, no doubt, next week. Dan Jovevski, good to speak with you. Thanks for joining us.